Happy 4th of July, everyone. We hope you're out enjoying the long holiday weekend. And what a week we've got to unpack. The Dow hit an all-time record. Chip stocks got absolutely crushed, and software names you might have completely written off came roaring back, all in the same short holiday week.
It was a massive, violent tug of war. Theo, did you actually have the stomach to look at the semiconductor board on Wednesday afternoon?
Laughs. I had to look away. It genuinely felt like the stock market had split into two completely different planets coexisting on the same screen. On one side, the rate relief party was raging, and on the other, tech was in a brutal freefall.
It really was fascinating. But the truth is, the money didn't leave the party at all. It just changed rooms. Let's dive into the mechanics of this great rotation, the new levels to watch, and what the charts are telling us, right after our disclaimer.
First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Welcome back to The Working Thesis. I'm Maya.
And I'm Theo. Quick legal housekeeping first. This show is for education and entertainment only, not investment advice. Companies like NVIDIA, AMD, Micron, or Palantir are just public examples we use to show you how the industry trends and market plumbing actually work. There are no buy or sell calls here and no price targets. Things move incredibly fast, so always verify the data live and do your own research.
The big one-liner for this week is that this was a textbook rotation, not a systemic risk-off panic. The broad indices actually closed up, even as they absorbed a very violent AI hardware sell-off under the surface.
That's exactly right. The Nasdaq was up 2.1%, the Dow added 2% for a brand new record, and the S&P 500 was up 1.8%. And crucially, the VIX, the volatility index, actually dropped over 12%.
That VIX drop tells you everything you need to know. It's like the high rollers at the casino leaving the highly volatile craps table and calmly walking over to the slower, steadier baccarat tables. The money didn't flee the building. It just rotated.
Exactly. It rotated right out of semiconductors, memory, and optics, and poured straight into software, financials, and late-week defensive plays like gold. Let's look at the exact scoreboard for this holiday-shortened 4-session week leading up to the 4th of July. The Nasdaq gained 2.1, the Dow 2.0, and the S&P 1.8. But the small-cap Russell 2000 fell 0.5%.
The 10-year Treasury yield settled around 4.48%. Sector-wise, software, tracked by the IGV, jumped 6.1%. Financials, the XLF, rose 3.8%. Communications added 3.2%, and healthcare gained 2.1%.
But the pain was incredibly concentrated. The semiconductor index, the SOXA, dropped 4.0%, and the SMH fell 3.2%.
Meanwhile, gold caught a massive bid late in the week, adding 1.2% as the dollar softened. The massive dispersion under the hood is the real story here. We are talking about roughly a 31-point spread from top to bottom across tech. Software and monetization names absolutely ripped. Palantir was up 14.5% with an RSI around 52, AppLovin up 10.5% near a 54 RSI, and ServiceNow up 8.1.
And the megacaps followed that bid. Meta up 5.9, Salesforce up 4.9, and Microsoft up 4.7. Power infrastructure held up beautifully too, with GE Vernova gaining 6.5%.
But AI hardware, memory, optics, and neoclouds got completely crushed. SanDisk fell 16.5%, CoreWeave was down 15.4%, and Micron dropped 13.8%. Coherent fell 12.4%. Applied Optoelectronics and Lumentum lost about 11%, and NBIS dropped 10.3%. LRCX and Qualcomm dropped around 7%. ARM lost 5.7%, Oracle lost 5.6%, and KLAC dropped 5.3%.
Yet the megacap semis held up the best. NVIDIA gained 1.2%, and TSMC added 0.4%. Which begs the question, Why did the dispersion look exactly like this?
It comes down to crowded positioning. The smaller and mid-cap hardware names were packed to the brim with highly leveraged momentum traders. When the music stopped, they all rushed for the exact same narrow exit door. The mega caps like NVIDIA and TSMC, however, have deep, structural, institutional ownership.
Precisely. They weren't nearly as crowded with flighty, borrowed capital, so when the leverage flush started, they held their ground. It was an unwinding of the most crowded small-cap trades, not a total abandonment of the sector.
So how do we interpret this rotation? There are three main reads, and the first is fundamental: capex-discipline. Triggers included a Meta cloud pivot where they're renting out excess AI compute and an OpenAI efficiency report suggesting inference costs could roughly halve.
In plain English, capex discipline means investors are demanding profits today. They are actively rewarding the software companies that are already monetizing AI right now, while punishing the hardware companies that demand billions of dollars in capital expenditure just to build the infrastructure.
And add custom silicon insourcing to that list. Amazon is moving its Echo and Alexa devices towards self-developed chips. Anthropic is building its own chip with Samsung, and Google's next TPU is reportedly eyeing Intel's EMIB packaging over TSMC's CoWoS.
Let's unpack that EMIB versus CoWeave's packaging news because it's vital. Advanced packaging is how you stitch the processor and the memory together into one superchip. TSMC has had an absolute lock on this with their CoWeave method, but Google reportedly eyeing Intel's EMIB method is a small, but very real, crack in TSMC's armor.
Exactly. The market looked at all of these efficiency gains and diversification efforts and asked, is AI compute overbuilt? The immediate knee-jerk reaction was to sell the hardware and buy the profitable software.
It's the classic shift from the builders to the users. Read number 2 is all about positioning and deleveraging. Fed watchers like Joseph Wang framed this wobble as leverage, margin, and options cracking, rather than a fundamental demand cliff.
In plain English, deleveraging is forced selling. When traders borrow money to amplify their bets, buying on margin, a sudden drop in price triggers a margin call. Their brokers literally force them to sell assets to cover the debt. That mechanical, emotionless selling hits the most crowded, highest beta names the absolute hardest.
That's exactly why the junkiest, highest beta names fell off a cliff, while quality, cash-printing names like Meta were the strongest.
One analyst noted that the Korea AI complex V-topped as the vanguard for this move. A V-top is exactly what it sounds like. A stock goes straight up the mountain, hits the peak, and falls straight down the other side without ever pausing to build a plateau.
And this is all happening against a backdrop of very large margin debt levels across the financial system. When margin debt is high, the market is fragile to any sudden shock.
Right. It becomes a mechanical, unwinding process that has nothing to do with the actual fundamental value of the companies being sold.
The third read is simply mean reversion. Maybe semiconductors just got too high after a monster run, and traders took profits, while software was simply too low.
Think of it like a rubber band stretched too far. Eventually, it snaps back to the middle. Software was deeply unloved, and hardware was historically overloved.
It's the least dramatic read, but often it's the one that is most true. It's a snapback that could easily run further into earnings and then reverse once valuations balance out.
So we have fundamental capex fears, technical deleveraging, and basic mean reversion. We're presenting all three. It's up to you to judge which force is really in the driver's seat.
But there is a broadening-before-the-top caution flag here. Investors like Jeremy Grantham and others have long noted that market tops often form when the high flyers start to lag while the broad index still rises.
Yes, money rotating into defensives and healthcare first. It rhymes qualitatively with the dot-com era. Usually, the market's true leaders roll over first, while the broad index keeps grinding higher for a while, looking healthy, before it eventually catches up to the downside. The generals get shot before the soldiers.
Seeing the Dow hit a record while the Nasdaq lagged echoes that exact dynamic. We have to flag it as a risk to watch.
But we also have to remind everyone, this is a likelihood game. Nobody predicts the future. It's just one read of what the setup looks like today. Let's talk about memory, because it's the linchpin of the whole hardware trade. Let's unpack the acronyms. You have HBM, which is stacked high-bandwidth memory crucial for data center AI. Then you have LPDDR, which is low-power memory used for AI laptops and phones. Demand for both of these is completely intact.
Exactly. This pullback is about price and positioning, not a demand cliff. Insourcing and efficiency gains mean the industry is diversifying and maturing, not that AI is slowing down.
And crucially, memory is in a structural shortage right now. To meet the massive demand for HBM in the data centers, the chip makers had to divert their silicon wafer capacity away from standard memory. That starves the standard market, meaning prices are going up, not down. Memory is not getting cheap.
So once memory and the arms dealers that build memory capacity fall to reasonable support, buyers can return. And that window usually opens at peak pessimism.
Which is exactly why we watch the levels, not the headlines.
Spot on. Let's outline some levels for semis and memory. And a massive reminder, these are technical levels to watch. Do your own diligence. These are absolutely not recommendations to buy or sell.
Let's start with a quick definition. What is a 200-day moving average? It is roughly the average price of a stock over the last 10 months. It is a slow, steady line that big institutional investors watch closely as a long-term support level.
And we also use the RSI, or Relative Strength Index. It runs from 0 to 100. Anything below 30 is technically oversold, and anything above 70 is overbought. Right now, Broadcom is sitting at a very oversold RSI of 40, right on its 200-day moving average around $361. NVIDIA is at an RSI of 41, also sitting near its 200-day around $191. That is arguably the cleanest quality at support setup on the board.
Meanwhile, TSMC is holding its 50-day average around $418, with a neutral RSI of 50. Micron, the memory bellwether, has a 50-day around $842, with its 200-day way down around $440. The watched re-entry zone is about $850 to $900 on a base and a turn. Applied Materials has a nuance. It's the furthest above its support, with a 50-day near $486 and an RSI of 54.
Right. Strong leaders can re-accelerate without ever tagging support. For the sector gauges, the SOX is around 543 and the SMH around 577 at their 50-day moving averages.
But we also have a persistence tail to monitor. The high beta equipment tail, names like Camped, AEHR, and NVMI, have already cracked below their 50-day moving averages.
If the heavyweights like Applied Materials, LRCX, KLAC, or ASML also roll under their 50-day averages, this pullback deepens significantly. That's the crack in the ice we are watching for.
So what is the re-entry playbook here? It is patience. Watch for a 2 to 3 day base to form and wait for that RSI to start turning up from below 40. Don't try to catch a falling knife. Stage your buys in tranches, keep some powder dry, and remember that the best entries usually coincide with the ugliest headlines and peak pessimism in the news cycle. Again, do your own diligence.
Moving to software, and with the exact same caveat, do your own diligence. The IGV around $97, its 200-day average, is the ultimate tell. Right now, the IGV RSI is 56. It's rebounding, but it is not stretched.
However, some individual momentum names are incredibly stretched. Palo Alto Networks is at an RSI of 79, and CrowdStrike is near 72. Both are overbought at 52-week highs.
They are extended, so don't chase them. The laggards, Salesforce with a 50-day around 175, Adobe around 236, and Microsoft around 408, are still below their averages. This is an early counter-trend rebound.
Watch for those 50-day reclaims as the real, not dead cat, confirmation. And here is the software persistence tell. If the IGV holds above its $97 line, plus the laggards reclaim their 50-day averages, plus financials continue to run, then this rotation has real legs.
But if the IGV stalls at 97 and rolls back below 91 while the semis stabilize, then this software bid was just a mean reversion bounce fading out.
That's the exact technical line in the sand.
So, what settles the debate between a capex peak and a leverage flush? The mid-July Mag 7 earnings. It is the single event that acts as the referee.
If the hyperscalers guide capex down and signal discipline, the software rotation and deleveraging read wins. Software keeps leading, semis durate more, and the memory peak timing risk rises.
But if they reaffirm the massive build-out, it means semis and memory were simply oversold and will snap back hard. Both scenarios are entirely live. We'll let earnings referee it.
And keep an eye on the FOMC minutes on Wednesday, July 8th, and June, CPI on Tuesday, July 14th, right as earnings begin to drop.
The macro tailwind feeding this rotation is a soft jobs report leading to a dovish-Fed. June jobs came in soft at 57,000, about half the 113,000 estimate.
May was revised down, and labor force participation hit a 5-year low. This is discouraged workers, not booming hiring. The result? No hike expected at the late July Fed meeting, and September hike odds slid from about 60% to 53%.
The dollar fell. The 10-year sat around 4.48%, and gold turned up late, adding 1.2% on the week, with Thursday up about 5% for gold miners.
That's a classic dovish dollar move, not a crisis move. The macro environment gave investors permission to rotate.
Finally, let's walk the asset chain on the Japanese yen intervention risk. The yen hit a 40-year low, spiking toward 160.6 on reports of Bank of Japan rate checks into thin holiday liquidity.
Step 1. The mechanics. Intervention means Japan sells US dollar reserves, mostly treasuries, and buys yen, pushing dollar-yen down.
Step 2. The dollar impact is just a modest tactical drag. The yen is only 13.6% of the dollar index, whereas the euro is 58%. Intervention buys time, not direction. The dovish no-hike Fed is the bigger, durable dollar driver.
Step 3. Gold gets a tactical 1 to 2 week tailwind on top of the Fed bid. Watch whether gold holds the bounce. It's a boost, not a regime change by itself.
Step 4. The double-edged carry trade tail. An orderly intervention is benign, but a sharp, disorderly yen spike can force a yen carry trade unwind.
We saw exactly this play out in early August 2024. That brief but violent cratering of global equities is the real cautionary precedent here. That kind of carry trade unwind would pour gasoline on the exact leverage cracking from our second read.
In that disorderly version, equities drop and gold could dip first on forced selling before resuming. The base case is orderly. The tail risk is violent.
Frame it as a volatility event to watch, not a forecast.
To wrap it up, the central debate between a capex slowdown and a leverage flush stays unresolved. And the one thing that settles it is mid-July Mag 7 earnings.
Exactly. We've laid out the tug of war. Remember, everything here is about levels and scenarios to watch. Do your own diligence. This is not investment advice.
Keep following the money. Until next time.
Take care, everyone.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.